Thank you, Madam Chair.
Mm-hmm.
The comments by Ms. Waters and Ms. Maloney, I think, headed the direction that my interest lies, and that is sort of the fascination with community banks from your perspective. When I look at the capital requirements, I see a very complex system. In other words, you really have generated a lot of parameters. And I kind of wonder if the same parameters were used in evaluating the failures. I've heard 2 or 3 of you talk about the 460 failures, and you give a lot of attention to real estate. Did you slice and dice the real estate as much as you sliced and diced the risk that you're going to have community bankers hold? In other words, I suspect that there were greater failures per capita, maybe in Florida or Las Vegas, Nevada, than, say, Tucumcari, New Mexico. I suspect that we didn't have a lot of out-of-state people coming in. I don't think people were rolling real estate. Did you do any analysis of the actual failures themselves before you said to community bankers you're going to hold these kind of assets? Because you're shutting down the future of small states. You're limiting it. And I'm asking, does your analysis of the failures go as deep and as finely sliced as your analysis of what you're going to have the banks to hold? Mr. French, you could start if you'd like.
Sure. You know, every time we have a failure, I think it's over a certain size, we do a material loss review. Our Inspector General does that, and we typically the profile of the failed banks in the last 5 years was the most frequent profile was a lot of construction lending, and funded by broker deposits would be the typical failed bank. So that was the kind of a bank that got hit.
And then, if I can interrupt right at that point, so a lot of construction loans. Now then, where there are a lot of construction loans in certain areas versus other areas, how many banks in New Mexico failed over construction loans, for instance? And I don't expect you to answer it, but I suspect if you look at the 460 bank failures, if you had a map of the U.S. and sticking pins in the places where the banks failed, I suspect they're going to be clustered in locations, and yet you're painting with the same broad brush across the entire country, saying that you're not doing one size fits all. And so my question is not so much about what caused them to fail. My question is about your process. Did it get as infinitely evaluative as you did on requiring capital for community banks? That's my question. So, Mr. French, yes or no? Have you sliced and diced it?
I don't believe we've sliced and diced the failed banks using the metrics in the...
No, that's not my question. My question is, if you put those pins in the map, did you say there are some places that inherently took advantage of the system and some places did not? I suspect we could have a different measurement criteria for Tucumcari, New Mexico, or Alamogordo, New Mexico, as we do in maybe one of the high resort areas of Florida. Does that, I mean, did you slice and dice it that finely?
I don't think we'd see many pins in the map in New Mexico, and I think, you know...
But we have the same requirements as if we were located right there in one of the high traffic areas.
And one of the frequent themes in the comment letters is exactly what you're suggesting, is that we painted sort of too broad a brush with the...
You know how miserable you all make my life? When you do these broad random stuff. And one thing else, my time is rolling down rapidly, and I'm probably only going to get to make the point. Did you slice and dice by size? In other words, did you make sure that most of the regulatory requirement fell on those who by percent failed in the greatest percentages? If I were to look at Wall Street banks, there are very few of them, the failure rate was fairly great as a percent. And when I do your percentages, you're rolling the 460 over and over and over again as if that's going to convince us. But when I divide 460 by 7,000 small community banks, I get a failure rate in the 5 to 6% range, and I wonder if you put that metric into your measurement before you went out and just put these rules out that frighten the daylights out of not just the community bankers, but the small states themselves who see capital drying up because of what you have done, just proposing your rules. And I think before you put these complex matrices together for community banks to put out what they're going to have to capitalize, you ought to do a better, more infinite study of what caused the failures and where they occurred than what you've done.